Hey guys, in this video, I'm going to talk about how to build a high yield dividend portfolio that is best for you. I'm going to walk you through the step-by-step process that I went through to construct my dividend portfolio. And I want to share with you some really important details that you won't hear anywhere else. I spent a considerable amount of time researching this topic to make this video as valuable as possible. So if you are considering creating a passive income stream through a dividend portfolio, be sure to stick around because I think you'll get a lot of value from this video. Now there's a ton of stuff to cover in this video, and so I want to dive right in. But before I do, I should mention that by no means am I an expert in dividend investing. And so if you think there's something I missed, if you have any questions, suggestions, any criticisms, please do leave a feedback down in the comments below. I would love to hear from you and see if there's any ways to improve what I've been doing. So I'm going to break down this video into three main parts, and I've added the timestamps down in the description below. So feel free to jump ahead to whatever section is the most interesting to you. This first section I'm going to talk about is being clear on what your goal is for your dividend portfolio. The second section of this video is going to be really the main part, and this is actually building a portfolio using ETFs. Now the third part is going to be really a crash course on building a portfolio in M1 Finance. I'm going to let you know exactly what you need to know to get started, some really important things that you need to consider before you actually sign up with them, and what you should know about their fees, about the different features they have available through their service. Now, I recently found out that M1 Finance is offering a limited time promotion for the month of January 2021. All new users will earn $30 if they fund $1,000 or more into their account for that month. Plus, you get a free M1 Plus 1-year trial membership for new users who sign up within 90 days. If you don't know what M1 Finance is, stick around because I'm going to show you why it's one of the best finance apps for passive dividend investing. And there's no commissions, there's no management fees. It's one of the easiest ways to customize and execute your investment strategy. And it is what I'm going to be using for my portfolio because I think it's a really great tool for building a dividend portfolio. Now, I do have a link down in the description below that'll take you to M1 Finance where you can go and get signed up and try out an account for free and see what you think. All right, with all that being said, I'm going to go ahead and go right into this and talk about what are the three questions that you need to be asking yourself before you build a dividend portfolio. And I think these three questions will help guide your decision. It will help guide your asset allocation, how much risk you want to take. And I think ultimately it will get you to your destination better if you understand exactly what you're trying to get to. So the first question I want to pose is, how will a dividend portfolio fit into your overall investment profile? And we need to account for all pre-existing investments and then consider how the dividend portfolio will fit into everything else that's happening. So if you're just starting to invest, I highly recommend before going to dividends to start investing into a low-cost diversified index fund before you start dividend investing, and lay that foundation first with a very broad market index fund like VTR or VOO before you start going into more of the niche investing strategies like dividend investing. Now, if you're considering replicating my portfolio as I walk through it later in the video, I think it's really important for you to understand the context that I'm coming from and what I'm trying to do with this portfolio. And for me, I already have investments in index funds in my retirement accounts for the long term that I'm not going to be touching at all for a while. I have several investment properties that currently generate some rental income for me as well. And this dividend portfolio is going to generate some additional income. It's gonna be another stream of income for me about 5 to 10 years down the line. The second question that we need to be able to answer is, when do you plan on withdrawing your dividends? So are you looking to draw your dividend income sooner or later? And this, along with your risk tolerance, will largely determine your mix of assets and your dividend expectations. And what I mean by that is this: the longer your time horizon, the less the current yield matters and the more the dividend growth will come into play. You know, if you're looking to draw your income a lot earlier than later, then the yield won't have much time to grow, and therefore you need to start with a higher current yield. Also, another thing to keep in mind is that the longer your time horizon, the more aggressive you can allocate your assets to grow your portfolio. So as I mentioned before, my initial plan is to start withdrawing my dividends in about 5 to 10 years, give or take, depending on the context of the economy at that point in time. And until that time comes, I plan on reinvesting dividends and until I start withdrawing. But there's two other considerations here. I need to start with a higher current yield compared to if I had a longer time horizon, because I won't have as much time for my dividend to grow. And on the other hand, I may need to be a little bit more conservative in my asset allocation because I won't have as much time to see my portfolio grow. But on the other hand, I'm willing to take on more risk because I'm not depending on the dividend portfolio alone as a path to get me to early financial freedom. The third question that I think is really important to address is going to be, what is your target yield and how much dividend income do you want to generate? And this is entirely your preference, but the inflation rate in the United States has averaged around 2% in the past 25 years. And so I think that acts as a floor to at least have a target yield minimum of 2% or higher, so that at least your portfolio is generating income that's not just keeping up with inflation, but exceeding the rate of inflation. So my stretch goal is $100,000 at a 5% yield, meaning at most I would need a $2 million portfolio. For those who are less mathematically inclined, 5% of $2 million equals $100,000. But honestly, $2 million is a really big number for me right now, and I have nowhere near that much capital. But fortunately, the dividend growth rate of my holdings will likely get me to a 5% yield with a smaller portfolio. So this means that my focus is really on the dollar amount of the dividend and not so much on the size of the portfolio. So really, I think the takeaway here is that you need to be flexible, have a target in mind, but hold loosely to it. All right, now I want to get into the weeds of actually building a dividend portfolio, and definitely stay with me here because I'm going to be doing this in 3 steps that are going to build on top of each other. So the first step I'm going to be talking about is understanding a core satellite strategy for portfolio construction, and I want to use M1 Finance as a jumping off point to do that. The second step is explaining a little bit about ETFs, which are going to be the building blocks for my portfolio, and I'm going to show you which ones are in my portfolio. The third step is I'm going to explain exactly why I chose my ETFs and why I allocated them the way I did in my portfolio. And I think that's really critical to understanding what makes a quality dividend portfolio. The best way to understand a core satellite strategy is to think of something like this image here, where you have a core holding in the middle and you have one or more satellite holdings that are supporting the core. So the core holding can be a single or multiple fund that usually involves a diverse basket of large cap companies, and it helps maintain low volatility in your overall portfolio and helps reduce the risk. The satellite holdings support the core holdings in different ways, like it may increase your holdings in a single sector, it may offset concentrated risk in another sector, they may provide exposure to an entirely different sector or an asset class. Now, I'm going to quickly switch over to M1 Finance because they provide some simple examples of what this actually looks like in real life. So here in M1 Finance, under research, you can get to expert pies, and these are the different categories of pies. Now, in M1 Finance, their pies are basically what they refer to as a portfolio. And we're going to get into one real quick here. Let's look at income earners. This is their portfolios or their pies that are focused on dividends and income returns. And here they have several different types of pies that are already preset. Let's just look at domestic dividends just as an example here. And you can, if you go down here, there's 3 different holdings in this pie. There's one core, which is VIG at 83% allocation, and there's 2 satellites. This mid-cap dividend fund at 13% and the small-cap dividend fund at 4%. And so this is a very simple core satellite dividend portfolio. Now, even though the expert pies are a great way to get started, I highly recommend you create your own pie that's custom tailored to what you are exactly looking to do, that fits your situation and what your goals are. Now that you understand the basics behind the core satellite strategy for building a portfolio, here is my pie / my portfolio, and I'm going to briefly explain each ETF that's here. But I want you to stick around for the most important takeaway, which is why these ETFs and how to allocate them so that you can build a quality dividend portfolio that's not just guesswork, but there's actually a method to the madness. Now, for each of these ETFs, I'm going to really briefly talk about their investment strategies, their expense ratios, their assets under management, and all that good jazz, just so that you're a little bit aware of what exactly I have in my portfolio when I start talking about why I selected them and their allocation. But if you're new to investing or you're new to ETFs, you don't know what they are, be sure to check out this video when you get the chance, where I go a lot more in depth about ETFs, index funds, and mutual funds, their differences and similarities. And I think they'll help clarify and give you a lot more confidence in what you're getting yourself into. But as a crash course, ETFs are a great way to diversify your holdings in any portfolio. They trade like stocks on any major exchange. And they're also very easily accessible through the major brokerage accounts. So if you have an investment account with Fidelity or Vanguard or Schwab, you should be able to buy into any of these ETFs. The first ETF I want to talk about here is the core of the core in my portfolio, and that is SCHV, or the Schwab US Large Cap Value ETF. And this ETF is allocated for 35% of my portfolio. And I love this ETF. It's got an expense ratio of 0.04%. Its assets under management is just under 8 billion. It's just over 10 years old, and it has 537 holdings, which is really fantastic. And its yield is a 3.07%. This ETF tracks the Dow Jones US Large Cap Value Total Stock Market Index. Now, if you're interested in learning more about this ETF, you can check out this video right here, where I go into a lot more depth in terms of why I think this is one of the best dividend ETFs that really nobody seems to be talking about. But I think if you are looking to have a solid dividend portfolio, I think you should seriously consider this ETF. Now, in that video, I talked very thoroughly about how to actually choose the best ETF for your needs. And so I highly recommend you take a look at that video to give you a sense of what to look out for as you're choosing your ETFs, because I don't really talk about that too much in here, but I think that video will help explain how I arrived at some of these ETFs that I'm going to continue going through. And I think that will point you in the right direction in terms of creating your portfolio by choosing the right ETFs to begin with. So the second ETF that I want to talk about is another one of my favorites, is SCHD, and this is the second core component in my holdings at 30% allocation. This is called the Schwab US Dividend Equity ETF with an expense ratio of 0.6%, which is again really great. It's really low. You're getting a great value for this ETF. The assets under management is just over $16 billion, so it's just about twice as big as SCHV. It's just under 10 years old from an inception date perspective, and it holds 100 companies with a 3.2% yield. What this ETF does is it takes all the companies with a 10-year history of paying dividends, and then within that, it excludes firms that don't meet certain fundamental screening requirements, like cash flow to debt ratios, ROEs, dividend yields, dividend growth rates, and it keeps only those companies that have really high quality metrics. And so this is a really fantastic ETF if you're looking to build your own dividend portfolio. I highly recommend it, but definitely do your own research and make sure that it's aligned with what you're trying to do. The third ETF that I want to talk about that's in my portfolio is the Vanguard Utility ETF, or VPU. I've allocated 12% of my portfolio for. This is one of my satellite holdings, and its expense ratio is 0.1%. Its assets under management is just over $4 billion. It's about 16 years old with 64 holdings at a 3.23% yield, which is great. VPU is tracking an index of US electric, gas, and water utility companies. And frankly, it's going to be as stable as you can get. These aren't industries that are going to be very volatile. They're going to be consistent regardless of what the economy is doing. So next ETF in my holding is Vanguard's Real Estate ETF, or the ticker symbol VNQ. Now this is another satellite holding of mine. It has it's allocated 13% in my portfolio, and it has an expense ratio of 0.12%, assets under management $30 billion, it has 178 holdings, and a yield of just under 4% currently. Now this is a really great ETF if you want to get a broad exposure to the US real estate market. It has commercial real estate, it has residential real estate, REITs, property management companies, and I think it's one of the most popular real estate, I believe it's one of the most popular real estate ETFs out there. The last ETF in my portfolio is the Vanguard Long-Term Bond ETF, or the ticker symbol BLV. This has been allocated to 10% of my portfolio. And again, this is another satellite component with an expense ratio of 0.05%, assets under management of just under $6 billion with an inception date just over 13 years ago. And it has about 2,600 holdings, and those are long-term debt like US treasuries, corporate bonds, and stuff like that. Now, it has a yield of 3.27%. This ETF is one I'm probably going to keep a close eye out on, because even though the yield is pretty attractive, bond ETFs have this weird functionality. It's a weird mechanic where they're very sensitive to interest rate changes. Now, the Federal Reserve is not changing interest rates anytime soon for the recovery of the US economy, but as interest rates go up, this bond ETF is definitely going to go down in value. That's something that you want to keep in mind if you're interested in dabbling into ETFs that are tracking any type of bonds. Now, I want to talk about why I selected these ETFs. And let's first start with the core ETFs. So I have SCHV and SCHD. This Venn diagram is showing you the number of companies in each of those ETFs and where they overlap. So between SCHV and SCHD, there's 57 companies between both of those holdings. And SCHV itself has 480 that are not in SCHD, and SCHD has 43 companies that are not in SCHV. I really like SCHV, and I made a whole separate video that I had mentioned earlier about why I like it, but I really like SCHD as well. It has a really good way of screening quality dividend companies. So I know that the 100 companies in SCHD are just really excellent companies to be holding for a long-term dividend portfolio. But I just thought SCHD didn't have as many companies as I would feel comfortable holding. And so that's where SCHV comes in with almost more than 500 companies. So by combining SCHV with SCHD, what I'm doing here is I'm amplifying the quality companies that are already in SCHV. So I'm doubling down on those 57 companies that I know are going to be just really excellent companies to be holding for the long term for my portfolio. Now, as for satellite ETFs, there's two reasons why I selected the ones I did. And the first thing is, if you look at this is Portfolio Visualizer. And what I'm showing you here is the results of the asset correlation matrix. So low correlation reduces your risk, and that is really the reason you want to diversify in your portfolio. Correlation is measuring how strong the relationship is between two asset classes. So a correlation of 1 means that the two tend to move in perfect tandem with each other, and you can see that result here between SCHD and SCHV. They're basically correlated around 0.97 and they move in tandem with each other. Now, a correlation of 0 means that the relationship between two assets is completely random. And here you can see that the long-term bond ETF BLV compared to SCHD is 0. It's even negative for SCHV. Now, a negative correlation means that the two assets tend to move in exactly opposite directions. So a correlation of high is 1, and from a diversification standpoint, that's bad. A low correlation is -1 or 0, and that is good for diversification. Now, the other reason that I included these satellite ETFs is because the three sectors, real estate, utilities, and bonds, tend to have very consistent dividends relative to other sectors. Now, let's talk about why I allocate the ETF shares the way I did and how you should go about deciding allocation. So there's two things to look at. First, this spreadsheet is the basic analysis I did to understand how the allocation will affect my expected dividend yield into the future. In this scenario, I'm looking at what my yield would look like with a $10,000 investment in 7 years. I can switch these toggles and the ETF share and see how my results change in the blue table. Now, I'm making some assumptions here that are listed in the footnotes. First off, I'm assuming I'm making a lump sum investment of $10,000 at the current date with the current amount and that there's no dollar cost averaging. I'm also assuming that I'm not doing any dividend reinvestment. I'm assuming that there's no changes in the price or dividend growth rate, so those are going to stay constant. I'm also assuming that there's no inflation or any types of interest rate changes. Anything that's going to be external that's going to impact these ETFs. For each ETF, you can find the price growth, the dividend, and dividend CAGR, or the compound annual growth rate, from websites like SinkingAlpha.com. Now, I project out the future price and the dividend based on the growth rates, and I'm going to leave the formula on the screen so that you can do this yourself at your own pace with the ETFs that you're interested in taking a look at. But based on the ETF allocation I set here, in this column, I'm expecting a 5.65% yield on cost on average. Now, the future yield is the future dividend over future price, while the yield on cost is based on future dividend over the current price, also known as the cost basis. So that is the price that you buy into an investment. So if I'm making a one-time lump sum investment, the yield on cost is the actual dividend return I'm getting based on my initial investment. And if I want to be more precise, I could repeat this analysis for each future year or month or whatever my interval is for dividend reinvestment and get a more precise result. But given the assumptions I'm already making, I don't think there's much value in making this more complex. The second thing that you want to look at is the sector and asset representation. Now, this table is showing the sector breakdown first within my core holdings in the pink, and that's SCHV and SCHD. Based on the 35 and 30% share I have for these ETFs, between these two, that's a 7-to-6 ratio, and that comes out to basically 54% and 46% on a percentage basis for just my core holdings. The sector that has the heaviest representation here is the financials at 21%. And the least represented is utility and real estate. So for a dividend portfolio, I wanted more representation in utilities and real estate. So this is where the satellite ETFs come into play and balance out the sectors. If I add in VPU and VNQ at 100% each for their respective sectors and allocate them based on their portfolio share of 12% and 13%, here's my portfolio's overall sector representation. Now, looking at the rankings, utilities, financials, real estate basically now round out the top 3 sectors in my portfolio. All right, I want to switch gears now and move into M1 Finance and show you how to actually create a pie to get you started. Here, this is basically my dividend ETF portfolio. And you can see here, just as I went through, my SCHV is at 35%, my SCHD 30%, my Vanguard real estate is 13%, utilities 12%, and 10% for my BLV long-term bonds. And see, this is basically my pie, just as I showed you guys. And I've recently started, it hasn't been very long since I've started funding this portfolio, but it's been performing pretty good so far, and I'm excited to see where it goes. I will share this pie in the description below. So if you choose to get started with M1 Finance and you like the pie I have here and you want to simply replicate it, you can use that link down in the description where I share this pie, and you can basically tailor it to whatever you want to use. Maybe you want to adjust the weightings, you want to adjust the allocations, maybe you want to add in a different ETF. This is totally up to you, but I'm just going to share it down in the description so that you can use it and use it as a starting point for whatever your needs are. But in order for you to start creating a pie, I'm going to go ahead and go into my pies here. And you basically, once you set up an account, you'll go into research and you'll start creating a pie by going to my pies. Expert Pies is right next to it. Go ahead and create a new pie. And this is where you can start looking for different stocks or different funds to create your pie. And so let me just go ahead and start creating a fund here. Let's just create a fake fund. Let's create a basic fund here. So let's say you want to add VTI, the total stock market index, into your fund. So we'll go ahead and add it to the basket, and it will just each of the funds you decide to add will be added here, and then we're going to work on the allocations later. So if we go back to funds, we're going to add, let's say we want to add a bond fund, Vanguard's total bond market ETF. So that, and maybe we want to go into some technologies here. So QQQ, which is the NASDAQ 100 companies, we'll add that here as well. And maybe we can add one more. Let's add, maybe we want to boost our value companies by using VTV. So let's go and add that. So we'll take these 4 funds and create our portfolio here. So we just created a new pie today, and they're all basically at 25% allocation. You can see here, these are the funds, these are the ETFs that we selected. Now we want to make sure that the allocation is according to what we desire. And so we need to go to edit, and we're gonna go ahead and maybe adjust these. So let's say we want to have the core holdings be VTI. We wanna maybe do bonds at 25. And then we want these other satellite funds. Let's say we want this to be 10% for value, and then for 15% for technology. And once you get a total of 100%, you know you're all set with your pie. You can adjust your names, add a description, and then you'll save. And then your allocation would be adjusted. You'll add it to your portfolio, and then basically you're all set. Now, if you go into my pies, you'll see it right here. And so that is basically how you create a pie in M1 Finance, and then you'll go ahead and fund it. And then you can, there's a few other things that I want to talk about with M1 Finance that are really important to understand, because if you're seriously interested in using it, I want to make sure that you're comfortable using this platform to build your portfolio and to maintain it. So this is really important for you to understand on how M1 Finance handles rebalancing. So they call it dynamic rebalancing, where M1 will automatically allocate the money that you deposit into your portfolio, into your cash balance, to auto deposit or to auto purchase in your portfolio. And it's going to try to maintain the allocation that you set for your portfolio. And so, for instance, like in this example here, right? If you have a $10,000 and you want to add $2,500, the $2,500 will go into the pies, into those ETFs or stocks that are underrepresented in your pie, and therefore it will maintain the proportion, the allocation of your assets. And that's what M1 calls a dynamic rebalancing, so that it keeps your portfolio in the same, how do you call it, the same risk profile, the same asset allocation that you've set it at. And if you need to adjust that, you can go into your pie and edit it. But for the most part, this is why it's such an interesting and such a cool tool to use to build a passive investing portfolio. Because if you have one asset, one ETF that's overbalanced, that's really done really well, then you're getting yourself a little overexposed in that, in that specific sector. Then you want to adjust it. You want to adjust your holdings, and M1 Finance will automatically do that with each additional deposit that you add into your portfolio. Now, the next thing that you should probably understand is how dividend reinvestment works. And here I am in my portfolio, and you can see here that you can basically, with the flip of a switch, turn on auto invest. And so your dividends and your capital gains, as I mentioned before, that you earn will simply be added to your cash balance, and then M1 will automatically reinvest those if you turn this on. And they will they let you set a minimum cash balance threshold. So as long as there's money above that minimum cash balance, M1 will automatically reinvest that into your portfolio and basically try to allocate it such that it's trying to maintain the asset allocation in your pie. Now, one last thing I want to talk about here is, how does M1 actually make money? What is their trick? And you may be wondering, this can't all be free. There must be something gimmicky about it, right? Well, so M1 is very transparent about how they make their money. And in this blog post, well, it's pretty clear. They lay out all the avenues that they make money off of their users. And basically, they make interest on cash that's held in the accounts. They make money on interest. They make money through interest on lending securities, and then they make money through borrowing. The M1, there's a feature in M1 called M1 Borrow, where they lend out money to their users. And then the other thing is that M1 also charges for a membership. There's an M1 Plus membership that I had mentioned briefly at the very beginning. So these are the ways that M1 is able to generate income, even though their basic user experience is free of charge for anybody. Now, M1 Finance does have some drawbacks that you need to be aware of, particularly around actively trading individual stocks or ETFs. Everything in M1 has to be traded inside of Pi, and you can't trade outside of it. And so if you're looking to make some kind of time-sensitive sells or buys, then M1 isn't exactly the best platform to do that. That's probably, you'll be better off doing Robinhood or Webull. The way M1 operates is that they basically have all the buys and sells happen at the beginning of the day for basic users. For M1 Plus users, they give you the option of doing some kind of afternoon trades as well. The other thing is that M1 doesn't give you the ability to trade precious metals or cryptocurrencies or options or futures, Forex, stuff like that. The more exotic types of assets that you might be able to find on Robinhood or Webull. If you enjoyed this video, be sure to hit that like button down below. Really appreciate it. And consider subscribing if you haven't already and hitting that notification bell so you don't miss on any future videos. Thanks for watching, guys, and I'll see you guys next time.